Great to see you here again. This is another video offered to you by the Ceuster Academy. It's about simple financial parameters that can be applied in projects and in the evaluation of investments. When you are here for the first time, please do not forget to click on the subscribe button. We will make new videos, more videos. If you want to be updated whenever we put a new video online, click on the bell button and YouTube will send you a reminder. Now, finance and financial parameters are very important in evaluation, and we're looking here at two simple parameters. Simple parameters because they are easy to calculate. They don't have, let's say, a lot of parameters in it. You don't have to be a financial wizard to calculate the parameters. Of course, they also have some disadvantages. They can be used, they are widely used, but you have to remember that they also have very important limitations. What are those two simple parameters? The first one is the payback time. The payback time describes how long it takes before the initial investment is paid back. So when we have an investment, we have monthly cash flows, for example, or yearly cash flows, and we see how many years or fraction of years it takes before we get our investment back. A second parameter is the return on investment. It describes the percentage return on the investment. Again, we have an investment, we have revenues, we have profits, and based on that, we can see how efficient our investment was. What is the return that we get on the initial investment? Now, let's have a look at the definition of the payback time. And like I said, is the time it takes before you get your initial investment paid back. And basically, the payback time is the division of the total investment divided by the periodic cash flows. Cash flows means the positive and negative cash flows. We can have some negative cash flows at certain moments. So we have to see how long does it really take before we have our initial investment back. The interpretation is quite simple. We have just the number of years or months that it takes. Now, what is the number? What does the number mean? Well, it depends on the type of business you are in. It's really industry dependent. Some industries may look at the payback time of a few months, some years. Others may be 10 years, 20 years, depending on the industry. You can imagine in automotive industry or in aviation, it takes a lot longer to get your initial investment compensated by future cash flows and profits. The interpretation here depends completely on your specifications, and it may be different from type to type of projects that you are executing. For example, an efficiency improvement project, you may say we have a payback time of 3 years, because that's typically okay for that. If you have a payback time for a very large investment, it may be 10 years or more, depending on your industry. Now, let's have a small example. Let's consider an investment of 2000K, and we have cash flows, positive cash flows of 25K per month. The payback time is then calculated by dividing 2,000 or 2 million by 25,000. We can also say 2,000 divided by 25, and we find that it gives us a payback time from 80 months. It's a little bit more than 6 years. Now, the thing here is that we can express this in months or in fractions of years. All depends on the parameters that you are using. Very simple parameter, not very difficult to calculate and easy to apply. Of course, we have to see what the disadvantages are. It's a very easy parameter. That's an, let's say, a very interesting way to consider what you're doing. Companies may prefer it over, and it's, let's say, very useful in case where we have uncertainties. Although there are some disadvantages. When we look at longer time investments, well, the cash flows do not really include the time value of money. So every cash flow that we have is considered at the same value. We don't discount the cash flows. There are not all cash flows included. So when we are looking at the cash flows, we only see until we find the recovery. The system doesn't look, or the method doesn't look further than that moment. So we find out now the cash flows are equal to the initial investment. All the other cash flows after that we don't consider. So just not looking into all the cash flows that we or that may be relevant for our project. It's not realistic because it doesn't take into account repeated investments. It may be repeated investments that we have to consider. The payback time does not include those. And it also doesn't consider profitability. It just says when is your investment paid back, but it doesn't say anything how profitable is our investment. We don't have any idea about those other parameters that we will see later in our other videos. Let's look at the second parameter, which is return on investment. The formula here is a little bit different. We look at the net profit that we make divided by the cost of the goods that we sold. So we're looking at revenue minus the cost divided by the cost. And that's in fact a parameter which has to be larger than 1. When it's equal to 1, it means that revenues are equal to the cost, so we are on a break-even point. Basically, it's profitable when we are over 1. Now, here also, we will see that there are some disadvantages. It's easy to calculate, but first let's have a look at a short example. The cost of the goods sold in our case is 200K. The revenue of the sales is 500K. So basically in the formula of the return on investment, the net profit is 500K minus 200K. And this we have to divide by the cost of the goods sold by 200K, which gives us a return on investment of 1.5, which is good. It's larger than 1, and basically it means that we have a return of 50% on top of our initial investment, which is a good element to consider. Now, what are the disadvantages for the return on investment? We can calculate it very quickly. It's widely used. It's in line with other parameters. And the main advantage here is that it eliminates the size of the company or the investment. So it gives you a relative value. It's not an absolute value. Of course, that may also be a disadvantage. Now, we are having problems here when we are looking at the return on investment, when people are ignoring the total picture. We may have, let's say, some effect when we are doing new investment in a division, for example. It may bring the divisional return on investment down. And typically managers or the people who are in charge of certain departments, they are also rewarded based on return on investment. Adding a new investment to your division means that your divisional return on investment goes down, and that could have a negative effect. So people are not really eager to do new investments because their return on investment would in fact be affected. We also have here the same, as a result of that, we also see that we prefer older assets over newer assets because investing in newer assets will reduce the return on investment. And again, our division may look as if it's not performing optimally. Now, we also can use it to have inefficient comparisons. The comparisons based on the return on investment are not necessarily really good to compare. We have to see what it really means. And that's an important weakness of the return on investment because it doesn't give the clear, objective picture of what's happening. Now, it uses here, and I already mentioned that before, it takes out the size of the investment. So a large investment or a small investment, they're all expressed as percentages, and the real value is taken out. Now, we can have an investment with a low value or profit, which has a higher return on investment than a larger investment with a higher profit. So the return on investment is not an ideal parameter, but we can use it in comparisons. It's one of the parameters that will give us some idea about the financial performance. Those two parameters are not the best parameters. They're easy parameters. Payback time, return on investments are used by many people. People will understand them, but they are not really the parameters we need to have an in-depth evaluation of our business, of our projects, of our investment. So we have to consider some other additional elements to this. That was another element about project evaluations, how to use the financial parameters for our different goals. We have to be careful about what we do when we have these parameters, and it's very important that we understand how time value of money works, how these simple parameters can be used to evaluate a project. Be aware that there are a lot more parameters, and these are just a few parameters that will help you. People in the financial area will understand that these parameters don't say everything, and they may not accept your evaluation just based on those two parameters, but they can be part of a larger set of parameters that you may consider. I hope you liked it. We will be looking into other parameters, more complex, more advanced parameters. These are some interesting parameters. They are not the best parameters to use. And when you're talking with finance people, you may have to use other parameters. We will look at more complex parameters later in the videos. I hope you enjoyed this video. Don't forget to hit the subscribe button, click on the bell so that YouTube can inform me when we have a new video. I thank you very much, and I'm looking forward to see you. Bye-bye.